Every time the rate cut happens, okay, it always starts off with the higher markets and not the lower price point markets, because lower price point markets have always done okay. Like they would always do okay because there are high yield in place and, there's not a lot of holding costs attached to it. It's usually the markets post $1 million mark where you see a lot of momentum coming through. So they're not high-end markets anymore. Like a lot of properties sitting at between 800 to say 1.5, 1.6, 1.8 million dollar mark. These are the markets that start seeing a lot of momentum going, right? A lot of people start basically investing and a lot of owner-occupiers start making these decisions about buying properties, especially with where the rental market is going. You would see a lot of owner-occupiers jumping into the market and, cashing up on some of these things, right? So usually that's where you would see major impacts coming through first before the lower markets going crazy about the interest rate drops, right? You're listening to Help Me Buy Property podcast powered by Investor Partner Group. We help improve lifestyles by building scalable and sustainable generational wealth and passive income streams. We do this via our ecosystem that is a one-stop shop to all property investment needs, from evidence-based, data-driven buyers agency, industry-renowned portfolio reviews and property strategies, property development with and for clients, tax, SMSF, business structures advisory, and cash flow real estate. Everything we do is to help people achieve financial independence and not just basic financial freedom by using property as a tool and as a medium. Presently, we've launched Australian Property Academy, where we are training and teaching buyers agents, property advisors, property strategic partners, and secrets to finding investor-grade properties to astute investors. Connect now to experience it yourself or drop in a line below at info@helpmebuy.com.au to get more information. Be kind and happy investing. This is part 2 of the first episode where we were talking about capital gains tax and negative gearing and the changes that are coming through that the government has announced. But there is also an interesting topic, which is in relation to interest rates. And, we've all been talking about interest rate cuts and interest rate cuts on the horizon. RBA came out in the short instance last week. I don't know when you're listening to this episode, but last week, where they came in and talked about no cuts for Australian economy. So in order to unpack these changes and what does it mean for Australian real estate market and the horizons for it, let's introduce my co-host, Miss Cheryl. Cheryl, how about you today?
I am awesome. There's always lots and lots of interest about interest rates. We've had lots of interest about interest rates for, I reckon, the last 2 to 3 years?
Yes.
More, ever since sort of the midway through COVID, right? Because we had beautiful low interest rates for all this time, and then COVID hit, and then interest rates went, and everyone started buying property, and then interest rates started they didn't really crawl up; they basically went.
Yes.
Yes. Interest rates for a lot of people have tripled as well. So those who had incredibly low interest rates have been begging for these interest rates to come down, because it's hurting a lot of households. So everyone's been hanging on for dear life, going, when are these interest rates going to come down? The RBA is saying, inflation is still not at the point where they're comfortable, bringing down interest rates. So
definitely.
In saying that, I think there's a lot of talk about it coming down very soon.
Yeah.
So we need to prepare for that.
It's very interesting, right? So, people who have seen, multiple markets, right, who have been in these for a decade or 2 decades, right? They know that interest rate always goes up really, really fast, and they always come down really, really slow. A lot of investors, I feel that, with the education that is coming out there, through podcasts and, mainstream media and Instagram and Facebook, people feel that the way that the interest rates have gone up is the way that they'll come down, right? So, but it never, ever happens that way. They go up really, really fast, but they come out really, really slow. They come down really, really slow. Yes, US has done an interest rate cut at 0.5%. I know New Zealand has done a cut at, some percent. But that puts us, Australia, in a very interesting spot. And so what it does is basically would ensure Australian dollar becomes a lot more stronger. It will basically, because their interest rates are higher, everyone's interest rate is lower from a cash rate perspective. And as the dollar is stronger, people would basically your economy remains a lot stronger too. Your people would travel more because your dollar is stronger. So you would see a lot more happening within the industry and economy too, right? But you can't keep your dollar as strong compared to US all the time, right? This is pure economics that we are referring to at this stage. Because if you have a dollar which is way too strong against US, then the imports and the exports starts getting impacted. And so there is a lot of turmoil at the other end. So from an RBA's perspective, and they think about all of these things together with the government changes around negative gearing and CGT, they want to wait and watch and see what happens in that space before they decide anything, because they are at the tail end. They are not at the forefront. They are never the trend setters. They're always the trend followers. They want to correct the trend. They don't want to set a trend. And that's what RBA's policy has always been. Now, if you go back and talk about, say, 10, 20, 30 years of how interest rate trends have looked like, the rates have always come down really, really slowly. If I give you some quick facts, it took 4 years to go for the cash rate to go from 4.1% to 7.8% between 2002 to 2006. When we are talking about the rate drops and the rate rises, let's look at some of the trends. And if I can share some facts with people, it would make a lot more understand. It would help them understand a bit more. Okay. So if you talk about cash rates, it took about 5 years for the rates to go from 4.3% to 2% from 2011 to 2016. Okay. And so you're talking about like 2.3% drop over 5 years, right? So it's not a massive, massive drop, right? But if you look at the rate rises, you can look at it going from 0.1% versus where we are to 4.35% in literally 2 years' time, right? Yeah. So you can see, and if you take yourself back, in 2002, 2006, you would see similar stories, right? The rates went up from, 4% to almost 8% in no time. But the drops took forever for it to basically come down, right? And the reason is that when the RBA is tightening the market, they tighten the market really, really fast. But when they're opening the market up, or when they're relaxing the inflation, or when they're relaxing the economy, they're trying to do it slowly and gradually. They don't want to open the tap and let the water flow, right? At a million miles an hour. And so it's important to understand these, because these are the impacts that people would see in their own personal life as well, right? So if you understand from an investor's perspective, a 0.25% drop in interest rate would only open up a borrowing by $20,000. Like, that's just nothing. Like, if you think about it, it's literally nothing. And it does not impact nor does it impact your cash outlay by that amount too. Like 0.25% means, in the bigger scheme of things, you might save maybe $200 a month or something like that. Nothing in the bigger scheme of things. So it's important to understand that while everyone is talking about interest rate rises or interest rate drops, these drops would take a lot longer, but the market responding to these drops would be quite significant. Okay. The other thing which is quite factual and important to understand is that when RBA is increasing the rates, they increase in with a pattern. So they don't go increase, decrease, and then increase again, and then they don't like volatility, right? So the first drop in the rate is basically them signaling that they are going to bring this rate back to equilibrium. So they want the cash rate to come back to around 3.5%, or maybe 4%, which is very close to where the inflation sits. Usually it's around 3.5%. That's where the equilibrium is for inflation and interest rates. And so they'll bring it down slowly because of all of these reasons. They'll bring this down slowly because they want to ensure that the market does not overreact to any of these, right? Everyone remembers what happened when the RBA governor said, "Oh, no rate rises till 2024," and the market went, "Oh wow, perfect, boom, let's go and go house shop," right?
And then
it's crazy, right? And
going,
and so that's why RBA is very, very careful as to what they say and what they do. Sometimes they don't have to say what they do; they just say it, and they get the response. And so it's important to understand some of these factual side of things first before we talk about what are the impacts or what are the sentiments of how the markets are responding or will respond to rate rises.
And I guess this is the part where everyone wants to understand of going, well, we know it's going to come down at some point. We don't exactly know when it's going to happen. Obviously, if you can look back at correlations between the US rate movements and Australia, you can make some sort of prediction. But it's more so, how do you prepare for it? How do investors prepare for it? Yeah. And the type of action we've got to take to be able to take action and be proactive the rest of the herd comes running and crashing in, because by that time you've almost missed the boat, right?
100%.
Yeah.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book. It's easy to read. It has a lot of stories. It has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book. And the market is the muscle memory, right? A lot of people don't understand this, and they might have heard about this. When you talk about markets having muscle memory, like in a suburb where the house price was before the market plateaued or the market fell, right? Everyone in the neighborhood knows. I remember around the corner, the house sold for $1.6 million. And so I know that back in my head, that, someone would come in and offer the same price when the conditions are right, when the sentiments are right? So market has that muscle memory. And, people who've been actively looking in the area, they know that this is where the market was, right? And so they come in bringing in emotions, especially owner-occupiers bringing in emotions to drive the market to that point quite quickly. So from an owner's perspective and from an investor's perspective, a rate cut on the horizon means that people who are on the fence, they'll invest hard. They'll invest fast and they'll invest hard. One of the lead indicators that we follow is just over the last month, the investor lending has gone up by 35%. Just in the last month, right? Investor lending has gone through the roof. And now this is just an indicator of people seeking approvals, right? And so lending approvals are the best indicator of you knowing where the market is going to head, right?
Yes.
And such a sharp jump at 35% lending is basically saying that people are gearing towards becoming ready for the market to basically go up or the interest rates to go down and the market to go up. And I always say this, you can never pick a peak and you can never pick a bottom. And so as a smart investor, you should always jump into the market before it's at the lowest, at the bottomest, like the lowest, and come out when you know that, there might be still another 5% growth in there. Just come out, right? If you are, trading in property market. But a lot of people don't do that. They become really greedy or they become really anxious and they're like, oh, the market is going to drop more and I'm going to wait around the corner. And then the rate drop happens and then you miss out an opportunity. I've seen markets growing by $10,000 to $12,000 to $15,000 a week. And people who have smaller budgets, because again, the rates are not falling fast and so you don't have a lot of servicing available. You might only have a servicing or a purchase price of, $450. And you would be priced out of a particular market that you're looking at very, very quickly. You would be kicked out of the market and then you'll go out there trying to find a new market. And while you're finding the new market, other people who've been sitting on that market, they push the prices out of that market too, right? And so you consistently miss out on the market. Still, you're basically priced out for 6 months or 8 months in a year. And that's what the scenario is. FOMO, you're missing out or you're overpaying on some of these properties because you're buying a wrong product because you're just trying to get into the market. So all of these sentiments play its part at the same time. And so as an astute investor, you need to understand that you would have a lot of opportunistic investors who have done this time and time again. People like us who are waiting for this and we were like, I've made my best money in times like this and I'll acquire and I'll sit on this because I know the market is about to turn. And then you would have, safe players in the market who would be like, I'm going to wait to see that rate cut. I'm going to wait to see what happens. And, you miss out on the market.
Yeah, that's right. And doesn't mean that it's the end of the world, right? But it is going to be, you're going to have to pay a bit more of a premium
course.
And are you okay with that? Just because everyone's risk tolerance is going to be a bit different. If you're going to be a bit more risk averse and you want to get some certainty, then be aware that that's going to cost you a bit more to purchase in.
Definitely.
And you're going to have more competition to deal with.
Yeah.
So if you're okay with that and that satisfies your anxiety levels, or like I said, your risk tolerance, then it's a decision that you make. But ultimately, it's around understanding where we are in the market right now, what the certain data points are, what the market is saying, and what the trends are saying, and making a call and making a call, whatever that call might be.
Yeah.
It's taking some sort of action, and as we always say, bring in your advisors to be able to it's how much borrowing capacity do I have? What's happening to your broker? Understand, because your broker is going to be able to understand what's happening with the lenders right now, how long that's going to take. Your accountant, obviously your property advisor as well. Start to get these people in place to really help you start to move forward and make some.
It's also risk versus reward conversation, right? So a lot of people, they might be struggling because the rates are higher and, they don't have the risk appetite. So the bank might lend them money, but they're like, look, I don't think that I want to manage this because there is an out-of-pocket attached to it. Because every property that you touch these days, especially as, your third or fourth property, you would be sitting at 7.5% interest rate, right? With the yield sitting at around 5.5% to 6%. So there is like $1,000 per month in out-of-pocket that you might have to cop up in, or more in a lot of these cases, right?
Yeah.
So the question becomes is, okay, how long do I need to keep up with this $1,000 before, I get to neutral or before the rate, drops, right? And so if I'm losing this $1,000 and I'm not paying a premium and the market grows and the rate cuts happen, where does, my break even happens and how comfortable am I? How much buffers do I have, right? I remember playing this game, back in the early days in 2008-9 when the rates went up and then it came down again. So post GFC, the rate dropped and then it went back up and then it started dropping again. And so when they were dropping, I did a lot of purchasing and I was very stupid at that time. And I bought a lot of properties. My whole portfolio was typically in Melbourne. And so it was all negatively geared properties. And the rates, when they started to go up, I felt the burn. I was doing 3 jobs, felt the real burn. And I was like, Jesus, I should sell something.
Yeah.
And so one of the strategies that I followed, which is quite interesting, I was talking about this with another client, was that I was sitting on a ton of equity. So I cashed out on the equity and basically managed my cash flow at that time through equity. Not the smartest way to do it. It's a very, very poor way to manage portfolios. Your income should be enough to sustain it. But in order to, sell, in order to not sell, that was the smartest way or the smartest play at that point. You use equity as cash flow and ride the wave for you to wait for that jump. And everyone knows what that jump did post 2016, 17 when the market just went through the roof, right? And so, when I'm talking to people right now, I always say to them, how comfortable are you taking that risk of using the equity to manage the cash flow, knowing that the rates cut are going to happen over the next 6 to 12 months or say 18 months, and it's going to outperform any markets that you're seeing? How comfortable are you taking that risk? Right? It comes down to that risk versus reward. And so for people who are comfortable taking the risk, they'll always do better.
Yeah. And so, and then, we talked about the risk, we talked about the, that there's going to be an impending rate drop at some point. Where, just to start to wrap up, then where do you see the markets that are going to be impacted the most?
Look, every time the rate cut happens, okay, it always starts off, with the higher markets and not the lower price point markets, because lower price point markets have always done okay. Like they would always do okay because they're high yield in place and, there's not a lot of holding costs attached to it. It's usually the markets post $1 million mark where you see a lot of momentum coming through. So they're not high-end markets anymore. Like, a lot of properties sitting at between 800 to say 1.5, 1.6, 1.8 million dollar mark. These are the markets that start seeing a lot of momentum going, right? A lot of people start basically investing and a lot of owner-occupiers start making these decisions about buying properties, especially with where the rental market is going. You would see a lot of owner-occupiers jumping into the market, back into the market and, cashing up on some of these things, right? So usually that's where you would see major impacts coming through first before the lower markets going crazy about the interest rate drops, right?
Yeah.
The other thing which is quite relevant and important is that because everyone's servicing opens at different times, you would see different impacts. And so you would see people with bigger servicing available to them would basically go in for bigger markets and blue chip stocks and just park in there if they're not astute enough. And then people who are at the lower price points or smaller price points on the servicing, they'll basically try to enter into the lower price point market and try to push that market hard. So the first and the foremost impacts are always in the markets which have contracted. So those are the first markets that basically turn around. So that's why when you see Victoria or Melbourne, and everyone talks about Victoria, Melbourne, is because markets have contracted in some areas by almost 15 to 18%.
Yeah.
And so those are the markets that would come back quite hard and quite fast, right? Because people would be like, well, I know that this suburb used to sell at 750 or 800. And so if I can score a deal at 650 today, it would always make a lot of sense.
Well, that's going to be another episode on its own, doing a little bit of a deep dive to sort of go, hey, where are the opportunities now? Let's prepare our audience for where we see there are the opportunities to purchase well now.
Definitely.
And again, the data around it and really the backing around those sorts of decisions as to why we think we're going to be some
100%
clever, smart buying.
Smart buying.
And
last but not the least, bringing this together, people who are not comfortable taking the risk in their personal name, if you have superannuation sitting on the side, and again, speak to your advisor, speak to your tax accountant, speak to your financial planner. But if you have super sitting on the side where you can leverage super to buy property and ride the wave, then do that. Play a low risk strategy. You don't need to play a high risk strategy. There are always ways to mitigate how you're going to build up your net wealth. Thank you for listening to us. And again, if you have any questions, comments, if you have any feedback in relation to how does interest rates impact you or is impacting you, do drop it into the comments and ask the questions to us. If you need a property strategy to look into, always reach out to us. Thank you for listening to us again. Take care, stay kind, be safe, keep smiling, keep investing. This is Moxin and Cheryl checking out. Adios.
Thank you.